How's it going, everyone? It's Sam. Today I'm talking about the best debt-free companies to invest in and talking through why that's important. So you should definitely watch through because I think there are some good insights that might change how you invest and make you look at these companies as really good solutions for kind of a safe dividend and safe growth. So first of all, I want to talk about why it's important. Why does it matter if the companies are debt-free? These are really unprecedented times where companies can go without making any money for months on end now. We are into a world where the government is willing to just shut down the economy if there's a health risk, and I can guarantee 50 or 100 years ago they wouldn't do that. 100 years ago they didn't really have the ability to broadcast it as quickly as they do now to tell us that, yeah, you do need to stay in and these are the dangers and this is the law going forward. So we're in a different time than we used to be. And one of the reasons this is important is because if a company has a lot of long-term debt and they can't work or they can't have people sell their products, then a lot of the time they just run out of money, right? So they don't have anything coming in, they have all these long-term liabilities, just like in your personal life. If you have a bunch of credit card debt and you can't work, or you have a bunch of mortgage debt and credit card debt and student loan debt and you can't work, you're gonna have a rough time going forward. So that is what I want to look at today. One of the main complaints of people that invest in index funds when looking at investing in individual stocks is that stocks are a lot riskier. And that makes sense. They're betting on one company that they don't really know how it's gonna shake out going forward. But if you invest in companies that don't have debt, it's a lot safer, right? So if something like this comes along and they aren't making any money, most of them have money sitting on the sidelines and they don't have the constant debt pulling away from that. So it's a lot safer going forward. Another issue that people have with dividend investing is that maybe dividends don't really matter, or once hard times hit, they're just gonna cut the dividends, right? So companies don't typically wanna cut the dividends because investors really like them, but they have the ability to continue those dividends and grow them if they don't have the debt constantly pulling at their bottom line. So if you invest in one of these companies and you have maybe a 5% dividend yield or something like that, and they've consistently grown them and they don't have debt, those are some of the companies that I'm going to look at today. The 3 companies I'm going to look at have been able to consistently grow. Well, if they continue to grow and they don't have debt, then they're a lot safer. I'll take a 5% dividend with increased stock price every day of the week compared to just investing in a company that doesn't pay dividends and has long-term debt and is maybe more risky. So when you look at the different ways that a company can spend the money that they're making, they can either invest back into themselves, so try to grow their business by spending more on research and development or buying more products or hiring more people. Another is to buy back shares, so that increases the earnings per share because there are less shares out there. Another is to hold on to more cash. Then the 4th different way is to give you more dividends. And then the 5th different way is to pay down debt. So when you think about a company that has high loads of debt, what are they going to do? They're probably going to either hold on to cash or pay down their debt quicker. Think about some of the companies that have been taking on more debt. In Carnival Cruise Lines, they had to get some debt that cost them, I think, 12% annually. That's just killing their bottom line. So not only do they owe, but they also owe the interest. And then you think of other companies like Disney, which they just haven't been able to open their parks up. They have basically zero income coming from their parks, and they have all this long-term debt, so they were having to cut their dividend today. So what I want to do is present a couple companies, 3 companies actually, to you today that can grow consistently and don't have that debt load that kind of restricts them in what they do. So before I go on to the next part, please subscribe below. Hopefully I can push this out to more people and help more people out, and like the video because it really helps out. I appreciate it. So I won't spend too much time on all these stocks, but we'll just get started here and I'll kind of move a little bit quicker than I typically do going through this because I don't want to hold you here for too long. But the first stock is Skyworks Solutions. So if you don't know what they are a semiconductor company, and they invest in technology that goes in cell phones, for instance, and they make different parts of the cell phone. So the major company that they work with is Apple, and they make a lot of the products for their phones. So as you can see here, they do pay a dividend, and their yield is pretty low right now. It's about 1.7%, trading for about $107 today. Their PE ratio is right around 19. They are poised to grow a lot soon because of some of the 5G phones and just some of the new technology coming out. So as you can see here, long-term cash and short-term investments, these are in millions. So they have about 1.1 billion. Now they also have some receivables and some inventory. So their total current liabilities is about $2.1 billion. Now look at some of their current liabilities. So short-term borrowings, 0. Total current liabilities, about 840 million, and that's mostly from accrued expenses and accounts payable that they haven't paid yet. Now long-term debt, 0. So total liabilities is about 840 million again. So they have 2.1 billion in total current assets, and they only have 840 million in liabilities. Now, if you look at their dividends, they pay about 1.7%, so not huge. They only pay 32% out though, and they've been growing that. So if you look here, in 2015, they paid about 78 cents a share. Now, in 2016, $1.08, $1.20, $1.40, $1.64. So they've been able to grow it about over 100% in the last 5 years. So if you're looking at this company, they don't have long-term debt, they don't have short-term debt. They're just increasing their earnings every year, and they're just increasing how much they pay you. So obviously their payout ratio is low, so they're still reinvesting in the company, which is good. I wouldn't want to see it around 100%. And they've been able to grow their dividends, so they're consistently giving you more each year. So that is the first company that I want to look at. Definitely take a look at them. I am invested in them personally, and I think they're a good company. The next company I want to look at is Rowe Price. So they are an investment group, and they yield just about 3.3%. I'm not invested in them, but I see that they have been consistently growing. Their PE ratio is about 16 going forward. If you look at their balance sheet, total cash and short-term equivalents, they have about 1.6 billion. They have about 2.2 billion in total current assets. And then when you look down at their liabilities, they have total liabilities of about 1.2 billion. So when you look, they have about twice as many current assets as they have liabilities. So they have a lot of runway. And when you look at their dividends, they pay about 3.3%, and they're paying only about half of their dividends out to investors. They're paying about half of their income out to investors, and their 5-year growth rate is right around 12%. So that's an insane amount. If you got paid $1 last year, you're going to get paid $1.12 this year, and they've been growing this for 34 years. So, I mean, they have a long history of this. They're a dividend aristocrat, which is someone that paid it for 25 years or more and increased it for 25 years or more. The fact that they pay that high is pretty significant because most dividend aristocrats don't pay 3.3%. So if you look at their growth here, you can just see them increase exponentially here. So they are a good company to look at. You know, going forward, they do active management a lot more than passive management, which we'll see where that goes going forward just because people are paying to have someone look at their money. I don't know how long term that can last or will last, but definitely take a look at this company. They've been able to do some great things with their dividend and with their assets, so take a look at them. Now, the next company is another one that I own. It's one of my largest positions in an individual stock, and that's Facebook. So everyone knows what Facebook is, but they also own Instagram. They also own WhatsApp. WhatsApp isn't big here in America, but it's bigger overseas. It's a messaging app. So definitely take a look at them. They've been able to increase like crazy and expand like crazy over the last few years. They are one of the largest companies in the world, but they're also growing a lot faster than their peers. So their PE ratio going forward is right around 28. I was lucky because I got to buy in when they were about $154. That's about what my cost basis is. And they have gone up to $210 now. So I've gotten about a 33% return. And if you take a look at their balance sheet, it's immaculate. Their total cash and short-term investments is around $60 billion. They've been able to increase that about $6 billion just from last quarter, right? So they have about $7 billion in total receivables too. So when you look at their total current assets, it's about $70 billion. Now, if you go down to their liabilities, short-term borrowings, 0. Long-term debt, 0. So total liabilities is about $33 billion, which seems like a lot until you see that they have $70 billion basically sitting in cash and receivables. So they've been able to grow like crazy. They don't pay a dividend or anything like that, but they're a long-term play that I think will do quite well. They haven't even really advertised as much as they can on Instagram especially, and I think they have a lot of room to grow. No one's really knocked them off the pedestal, and everyone was worried that, the next Vine or Snapchat would take over, and they haven't. They've just kind of fizzled away while Facebook has remained up at the top. They have a ton of cash and a ton of runway if anything like this happens. And when you think about it, the economy is shut down, and that really doesn't affect Facebook that much. Sure, some people aren't willing to advertise as much on their platform, but so many people are using their platform now, it almost evens out. So those are the 3 companies that I really see posed in a good position, and they are debt-free. So do your debt-free scream.
Hear a debt-free scream. 3, 2, 1. I'm debt-free!
And I think that they're a safe way to invest in individual stocks that kind of gives them a long runway and really cuts down on the chances that they go out of business, especially in the short term. And they're definitely worth looking at. So I appreciate you guys watching this. Again, hit the subscribe button if you haven't done that already. Hit the like button. We got 6 or 7 likes last time, so let's try to crush that this time. And I will see you in the next video. Bye.